Cryptocurrency is a form of digital money that's built using blockchain technology. Blockchain technology operates on three simple principles. 1. Encryption, meaning information is transferred securely between authorized parties. 2. Transparency, meaning all state changes are maintained on a public log. And 3. Distributed networking, meaning data is exchanged on a peer-to-peer level, eliminating unnecessary intermediaries. Combined, these principles enable decentralization. Decentralization makes it possible for anonymous parties who don't trust each other to productively coordinate, collaborate, communicate, and transact en masse in real time. This dispersion of power, information, and value across global systems opens profound possibilities for complex human-machine interactions on a scale we've never seen before. In theory, the adoption of blockchain technology and cryptocurrencies by extension promises to address the 1. Monopolization of data and wealth by large multinational conglomerates. 2. Censorship in decision-making mechanisms across democratic, pseudo-democratic, and authoritarian governments. And 3. Opaque incentive structures that exist in top-down, centralized architectures and systems. With that being said, the decentralized technologies that will enable these things also provide new mechanisms for large-scale illicit transactions, wealth storage, and global criminal operations. And with the current technical, regulatory, and environmental challenges of supporting transactions between fiat currencies and cryptocurrencies in controlled environments, crypto-based crimes are on the rise and difficult to quantify. With this in mind, some of the questions we'll strive to answer today include: how did we get here? What are we doing about it? And what can be done differently? Innovation in the financial sector has taken many forms over the years and greatly transformed the way we live our lives. Looking at payment systems specifically, the diffusion of technology has given rise to more efficient mechanisms to make and receive payments, settle accounts, and transfer funds across borders. At its core, these innovations can largely be distilled into one word: speed. As we moved from gold to cash to checks, credit cards, and debit cards, we accelerated the speed of cash flow for finance and commerce. The first foray into digital payments took place less than 30 years ago when, in 1995, the Stanford Credit Union pioneered transactions over the internet for its campus community. This leap forward required a massive shift in paradigms. Whereas financial institutions previously relied on marble architecture and brick-and-mortar branches to project trust, digital trust was won by ensuring high confidence that 1. The digital banking customer is the person they claim to be, and 2. That person was authorized to perform the transaction they request. Cryptocurrencies emerged from various earlier experiments to improve digital trust. At the crux of these experiments was the goal of tackling the double spend problem. That is, the challenging task of ensuring digital money is not easily duplicated. For ease of demonstration, you can think of it like this. If digital objects like files can be copied from one location to another, how do we stop the same thing being done to digital money? In Web 2, digital payments relied on trusted third parties such as banks and payment processors to prevent double spend by privately verifying every customer and each transaction. In Web 3, cryptocurrencies solve this problem by allowing independent network participants to verify every transaction using an immutable distributed ledger. With that being said, the encryption protocols and algorithms that enable peer-to-peer payments via cryptocurrency also present the double-edged sword of secure communication between two parties without users having to divulge any personal information. Digital fraud opened a new frontier for money laundering. Criminals with online access and ill-gotten personal credentials could now make transactions from anywhere in the world without physically leaving their desks. The steps involved in the money laundering process remain the same. 1. Placement. Injecting money from illegal sources into the legitimate financial system. 2. Layering, concealing the source of funds through transactions and bookkeeping. And 3. Integration, withdrawing funds from legitimate accounts for discretionary use. But the mechanisms for fraud became more complex in Web 2. Using proxy servers and anonymizing software, like VPN and Tor, for example, criminals could 1. Build online businesses and hide them behind legitimate store websites. 2. Perform online auctions and sales on darknet marketplaces. And 3. Leverage gambling and virtual gaming websites to break up funds into multiple small deposits. In Web 3, encryption protocols introduced a new one-stop shop and, depending on jurisdiction, perfectly legal mechanism for fraud: crypto mixers. Mixers receive crypto from customers, stir in crypto from other customers, and output an equivalent amount of crypto at the end of the transaction. Putting it into real terms, let's say that person A wanted to send 1 Bitcoin to person D. If sent directly between their wallet addresses, on-chain data could be used to determine the source and the destination of the funds. If sent through a crypto mixer, person D still receives 1 BTC, but it becomes rather difficult to identify the source of funds. There are 2 types of crypto mixers. Centralized mixers are third-party services that are operated by small teams. However, these types of mixers have 2 shortcomings. 1, they keep internal records that can connect transactions, and 2, there is no guarantee that funds put into the mixer will ever reach their final destination, leaving users vulnerable to theft. The second type of mixer is called a decentralized mixer. These operate in a similar fashion to the decentralized, but instead of relying on intermediaries, they leverage the use of open source protocols for operation. In the introduction to mixers, it was mentioned that they can be perfectly legal depending on jurisdiction. So why is that? Well, crypto mixers exist in a legal limbo because they can sometimes provide a necessary added level of security for businesses and high net worth individuals to move funds without public scrutiny or fear of attacks from adverse actors. Now, that might seem confusing. Aren't crypto transactions supposed to be completely anonymous? How can transactions be tied to real-world entities? In reality, the ability to identify the owner of a wallet address points to a loophole in the anonymity promised by blockchain networks. Simply put, reused receiving and sending addresses used in crypto transactions can be leveraged to cluster these transactions on the blockchain and pinpoint the people or organizations behind them. This circumvention of total privacy is why transactions on the blockchain can more aptly be characterized as pseudonymous. Blockchain forensics is the use of scientific methods to take data from the blockchain for the purpose of interpreting the flow of digital assets and uncovering the real-world entities behind them. It is one of the most effective tools in the arsenal to combat crypto fraud. Effective blockchain forensics requires intimate knowledge of the crypto landscape in order to analyze various techniques used, such as mixers, chain hopping, so moving transactions from one blockchain to another, and structuring, doing multiple small transactions to hide the large movement of assets. The ultimate objective of blockchain forensics is to identify the real-world entities, or people and organizations, behind illicit activities. When conducting blockchain investigations, speed to action is of particular importance as exchanges, law enforcement, and regulators need to be able to move quickly in order to ensure that digital assets aren't moved out of jurisdictional reach by criminals. In this next section, we'll explore barriers to quick crypto crime response with a particular focus on data silos, forecasting through the rearview mirror, and a one-size-fits-all approach to analytics tools. Central to successful blockchain forensics is attribution data. Attribution data is ownership information for wallet addresses which can be used to de-anonymize crypto wallets, uncover fraud schemes, and identify criminals. One glaring problem currently faced in the Web3 space is that the tools we use to combat crime in effect map transactions and build clusters using intelligence from closed proprietary databases. The problem with this is that it often paints an incomplete picture of the threat landscape. The issue this raises is that if we put incomplete information into our models, we get incomplete information out of them. And direct impacts of this include bad insights, poor decisions, and bad crime response frameworks. Garbage in, garbage out. Further compounding some of the challenges faced in responding to crypto-based crime is our heavy reliance on using historical data to approach unfamiliar things. From a data science perspective, rearview mirror modeling runs into three considerable limitations. 1. It introduces bias through inherent modeling assumptions. 2. It excludes external variables from serious consideration. And 3. It increases the likelihood of correlation being misinterpreted for causation. In real time, this presents massive challenges for 1. Inference, that is, drawing connections between variables on the basis of evidence and reasoning, and 2. Extrapolation, so predicting future trends based on current trends. Because data silos make it difficult to determine what data is wrong, much different from the rest, too similar to the rest, or missing, and because models themselves carry inherent limitations, models built on silos to counter or anticipate crime will always be one step behind. Issues with our current approach to information management scale beyond how we aggregate, analyze, and deploy data. We also need to revisit the way we enable people to interface with that data. Most intelligence tools today are centered around a read-only approach, meaning that users can read or copy stored data, but cannot modify or integrate their own data feeds to dynamically write new information. On the surface, this seems like an optimal approach because it protects data quality and prevents accidental tampering with single sources of truth. But in reality, it's quite problematic for effective collaboration because it 1. Overcomplicates workflows, meaning that users are unable to rectify inconsistencies across different forensic tools. 2. It removes context, so that intelligence was presented without the context of its source, which often renders it meaningless to the reader. And 3. It strips empowerment, meaning that readers are unable to maximize the value of data reuse because they aren't given the flexibility to assess where these assets might fit operationally and strategically within different environments. This one-size-fits-all or one-size-fits-most approach makes it difficult to detect systemic errors as quickly as possible, correctly diagnose emerging threats, deploy intensive interventions prior to times of acute crisis, and increase stakeholder participation and support satisfaction. Data is a powerful tool, and if used correctly, it has the potential to turbocharge decision-making, accelerate innovative strategy formulation, and improve fraud prevention success. The future of AML won't solely hinge on the ability to make better decisions in the moment based on what has already happened, or to have more robust attribution data for more efficient screening. Instead, we would argue that the future is prescriptive, a combination of holistic forecasting built on robust sets of real-time data and optimizing operations to better suit the context of a given environment. By empowering users to better control how they interact with data, as well as reducing barriers to the free flow of information, we can complement the insights extracted from historical data to provide greater transparency of assumptions, reduce biases, and paint a fuller picture of the threat landscape. For all stakeholders, this shift will simplify analysis and review of the knowns, unknowns, and known unknowns, enable deeper understanding of the implications of all available decision options, and improve network resiliency, allowing us to better scale to meet unpredictable developments. Some of the tough questions we'll need to ask ourselves moving forward will include: what trade-offs are we prepared to make, and how can these perceived losses actually be viewed as areas of opportunity? And what areas do we lack competence in, and how do we overcome them as barriers to achieving our ideal state of safety and security? A guiding tenet in navigating these questions should be intentional change. In truth, the gap from where we are and where we want to be is not a massive one. But at the same time, people and organizations don't change quickly and decisively. They continuously evolve through a cyclical process. By pinpointing our position in this current stage of knowledge and maturity, we'll be able to better gauge where our progress is relative to criminal actors and establish how we can improve our performance to respond to where crypto is headed. Global crypto adoption is growing at an exponential rate. And while there are a number of figures floating around, current estimates for the increase in crypto ownership in 2021 range between 150 to almost 900%. So there's no denying that transactions via encrypted digital assets are going mainstream. And while we don't know which coins or tokens will continue to exist in the long run, we can be sure that the disruption they have caused is here to stay. But what can we do about the trends we're seeing and some of the risks they pose? Moreover, how can we stay ahead of the impending wave of crypto-based crimes? The answer lies in better understanding cybercriminals and the adversaries we face. Because the truth is, regardless of all the access controls, secure configurations, and roles and responsibilities we assign, we will never be able to determine risk, protect assets, and isolate areas for increased investment if we don't have a pulse on the growing and ever-changing scope of potential and recognized bad actors. Bridging the gap will require a fuller picture of the threat landscape. By integrating data sources and increasing synchronization, we will be able to identify missing links in our collective understanding of emerging threats and identify the vulnerabilities present in our individual networks as well as the other networks we interface with. The best way to stay ahead is to come together and alert one another of new information as it arises, regardless of whether or not these attacks specifically target our respective areas of operation. This will not only allow us to better defend ourselves, but organizations will also be able to confirm whether they have fallen victims of the same attacks in the past. When we talk about the need to shift from descriptive or diagnostic AML to more prescriptive measures, it's important to note that more enriched threat intelligence constitutes only a fraction of the measures we need to take in order to position ourselves for success. It'd be a massive understatement to say that security and fraud prevention are more complex now than ever. Yet, counterintuitively, the solution isn't to simply increase defenses and build better walls. We saw in Web 2 security that this approach breaks down as attack surfaces grow larger. Beyond better defenses, we need to ensure that we make technical tools more robust while simultaneously maintaining streamlined workflows to position teams at the edge. We can do this by allowing users and their networks to communicate with intelligence tools, by providing low latency analytics, and by enabling rapid deployment of targeted responses to emerging situations. But the buck doesn't just drop at technological innovation. We need to also consider how we can create greater resilience around the people, processes, and governance of our organizations. This approach is commonly referred to in Web 2 as holistic security. In order to take the concept of holistic security beyond the foundations laid in Web 2, it's imperative that we don't limit ourselves to the confines of historic coordination mechanisms. Decentralization via blockchain technology presents novel ways to support remote interaction, discussion, and production of shared intelligence. And it will be the key to increasing the productivity and impact of teams around the world. Leveraging blockchain technology, previously siloed teams can, among other things, 1. Transfer sensitive information securely, without the risk of interception by malicious parties. 2. Access information as soon as it's broadcasted to the network and whenever it's needed in the future. 3. Maintain a shared, unchangeable ledger of chronological developments. And 4. Automate contract execution and the sharing of network resources. Embracing open source workforces will require a shift from the prevailing belief that it's not possible to advance individual interests while simultaneously contributing to a common good. But by thinking of each other as collaborators and not competition, we'll be able to collectively benefit from the efforts of our trusted partners. To boil down what can be done differently in the fight against crypto crime, we propose that communal capacity can be further built out by 1. Developing a secure, crowdsourced repository of intelligence on malicious actors in the Web3 space. 2. Establishing a set of coordinated responses against emerging threat actors. 3. Disrupting criminal activity before they exploit individual and network vulnerabilities. And 4. Reducing the perceived rewards of financial crime. Doing this will require 1. The dismantling, or at the very least, reduction of data silos. 2. The implementation of holistic security frameworks, with emphasis on positioning at the edge. And 3. Embracing the decentralized coordination of teams through the use of blockchain technology.